So we're going to move on to Michael Mesher, and Michael is extraordinary hedge fund trader. He's had a 570% return this year. Michael, we did a poll on questions that people wanted you to ask, and I think that people are very interested in special situations, et cetera. And also, any crypto special situations that may be existing. So why don't you introduce yourself, Michael? You've got the full 25 minutes, and we'll go from there.
Okay, perfect. My name is Michael Mesher. I run Gammon Capital. We're a derivatives trading firm. We specialize in AI and machine learning applied to the options market. We do a lot of quant work, and we also do a fair amount of special situations, which based on the questions, I think I'll touch on in just a couple minutes. Just as a quick background, as Marty had mentioned, last year was a great year. We put up about 570% gross. Prior to starting my own firm, I had worked as the head of special situations volatility trading at Lehman Brothers and then subsequently Barclays. So we've also got a great background and pedigree when it comes to some of these more special situations that we'll touch on in a minute. But before we get there, I think it's probably important to talk about the quant program that we're running. And this is really the bedrock of our program. I'd say about 90 to 95% of what we do is quant based in the option space. And when you take a look at the performance that we put up last year, that was largely driven by quant. We had a little bit of special sits in there, but that was largely driven by quant. So what I'm going to do here is I'm going to share my screen so that you guys can all see how we structure positions. Let's take a look at this one. Okay. Can you see that, Marty? Did my screen show up there?
Yes, it is. It says
great.
Sharing.
So what you're seeing right here is two portfolios. One is the blue line, which is our typical portfolio structuring. And then the orange line is the S&P. And the reason we put this up there is to really kind of give our investors an idea of what typical positioning would be like for our fund. So frequently, we're usually performing on the upside with the market on about a 2 or 3 to 1. And when the market sells off, if it's a transient sell-off, you're probably losing on about a 2 to 1 until you hit down about 7% or so. And then you start making money very, very quickly. And that's kind of what happened in 2020 or 2020. We had a couple of other interesting special situations that we were able to do well on. But it's important that everybody understand our portfolio and the perspective of these two graphs. The left obviously being a little bit more evidence of the tails and what happens when the market hits those really nasty black swans. And then the graph on the right is over there just so you can understand what a more normal environment is. So one of the questions that we typically get when we show this is, how do you construct these nonlinear returns? How are you able to protect these tails like this? And a lot of that really comes down to the way that we're leveraging the AI and the machine learning in the option space. Now, the great thing about options is that they allow you to have these nonlinear payouts. So you have a lot better control of your risk, and specifically the types of rewards that you're looking for with this risk. When you run a long options portfolio like we do, we're frequently getting options that are available to us where it's a risk 1 to win 5 or 10 or 15 type of proposition. So when we construct our portfolio, we spend a lot of time interacting with our machine learning software, and that's able to go out into the options market, and it's able to assess all of the different investments that are available to us. Now, all of that is done in the context of the current market environment, and all of that is optimized towards what we believe are the proper investing objectives, and that's what led to the performance last year. So that's pretty much what our quant program is about. One of the other things I want to talk about a little bit is the special situation side. So we do special situations when they come up. It's not often, and it's a pretty high bar to get into the portfolio when it comes to a special situation. And by high bar, I mean it needs to be an investment that's potentially going to be returning high double to low triple digits. Anything that's going to put up maybe like a 5–10% return isn't really worth the time, considering the other types of investments that we have. But one special situation that we spent a lot of time on last year, and it's actually going to be relevant in the coming year, is around the CARES Act. Now, if you guys rewind the clock back to March of last year, and you remember the original stimulus, it was called the CARES Act. It was a couple thousand pages long. And that got published. It's actually surprisingly difficult to find the full text of that document online, but with enough research, you're able to go find it. And we read through it, and we were looking for certain passages that would have presented risk in the markets. And we found some of those. Specifically, and you guys can check this for yourself, this is on my LinkedIn, but you can also go to the .gov website and check it on your own. If you go back to the CARES Act and you look at sections 4012 to 4015, effectively what it's saying is any requirements under United States generally accepted accounting principles have been thrown out the window for financial institutions in 2020. So basically what that means is any impaired debt that these financial institutions were carrying in 2020, as long as it can be argued that the debt has been affected by COVID, which is all debt, the people were allowed to carry that as fully performing debt on their books. Now, in addition to GAAP standards getting thrown out, FASB, the Financial Accounting Standards Board, those got thrown out. Any banks, whether it was a regional bank, community bank, or even the mega banks, to the degree that they fell in violation of their leverage ratios and a lot of the regulatory requirements, they all got grace periods. And a lot of people just aren't aware of this because nobody really went through these documents. I mean, in the 7 or 8 months that we were following this, we never really saw anybody else talk about this. And the reason this made the special situation bar for us is because all of this accounting treatment had an expiration date on it. And that expiration date was December 31st. So had the stimulus payment not been drawn out and extended, there would have been a very, very serious problem taking place in the markets this week because financials are starting to release earnings. This week, we would have gotten absolutely clobbered. And nobody knows about this and nobody saw it coming. Now, the interesting thing is, why hasn't this happened? It's because the stimulus got extended. And I talk about this a little bit on my LinkedIn page as well. You guys are all welcome to check it out. But suffice to say, all of that accounting treatment and the cooking of the books, if you will, is getting extended out for another year. So now it's not until January 1st of 2022 that this grand day of reckoning is coming. So that's one special situation that we thought was going to be more of a catalyst for last year, but it's going to be a catalyst in 2021. And we'll probably start positioning for that special situation probably around Q3 or Q4 of this year. Now, I know there was also
Hey, Michael, just real quick. Yeah, I'm kind of old school, but if we used to call something like this extend and pretend.
Yeah.
Okay, got it. Okay, that's all I wanted to know.
Yeah,
right.
you can say that for sure. Sorry, the sun's moving on me here. Let me try and get over here a little bit.
Great, keep on going.
You guys had also asked about special situations in 2021. In addition to the CARES Act extension, which is very material and definitely needs to be kept an eye on, we're also starting to venture out into the crypto space. We've done some work in there. We've had some interesting, very exceptional trades with phenomenal returns, returns that are not reflected in the fund stream because we have not run this trade through the fund yet. We wanted to make sure it worked first, and we're about to start running the trade through the fund going forward. But with respect to the crypto space, we've innovated a way to basically construct a risk reversal on the cryptocurrencies. And by risk reversal, what I mean is we have a way of structuring exposure to the crypto space where we're protected on the downside in case the crypto market ever starts to sell off, but we have significantly more upside return possible to us. So another easy way to think about this would be, say, like a call option on crypto, except these call options are very different than anything that you might ever find in some crypto listed exchange. These options that we're able to structure, for example, we're able to acquire certain cryptocurrencies for about 5 cents on the dollar. So this is a new special situation that we have done outside of the fund, but now we're going to include it in the fund going forward because it's been so successful. That's pretty much the 20,000-foot overview of the Quant program, and then a couple examples of special situations that we have. If there's any questions, I'm happy to start getting into those, Marty.
No, I think this is great, and I think it's really worthwhile that. So I guess my real question is, do you think that given the tenure of what's going to be happening with the Fed and this kind of regime of extension, do you think it's going to cause more volatility and more special situation opportunities?
So with regards to the special situations in the equity markets, there's still a couple catalysts that we've been paying close attention to that might lead to a little bit more volatility. These are actually the same 3 catalysts that we've been keeping an eye out and preparing for the past few months. One, obviously, the CARES Act, that ended up getting extended. 2 is the peaceful transition of power. We never expected the transition to be peaceful. As awful as the insurrection was, we were fully prepared for that. frankly a little bit surprised that the market didn't treat that more seriously. We think it's very evident that this is not going to be a smooth transition of power, even in the wake of what was recently said. So we're ready for about the next week of exposure. That's going to be pretty significant. And then in addition to that, we actually have, let's see, in terms of the risks.
I'm sorry, Michael, you're saying that this isn't over. That what
It's not
happened?
over, no.
Okay,
No.
yeah, strange. Okay, no,
Yeah.
I mean, I hear the FBI reports, but it seems hard to believe.
Yeah, so the next week might be a little bit rocky just in terms of transition of power. Another risk is obviously COVID. As Biden comes into power and COVID's so widespread in the US, he's going to have to take a different approach to this. And we wouldn't be surprised to see if he starts tamping down on exposures. And one of the natural externalities there would be the market might sell off because it's expecting more of that kind of slowing down of the economy as people aren't allowed to go out and basically make exchanges. Now, whether that happens or whether none of these risks transpire and it's just straight right-hand tail all the way because all we're doing is printing money, the great thing is we have this nonlinear exposure where we're able to make money in both of those situations. Any other questions?
No, I think we need to go on. Keep on going.
Okay. So outside of that, like I mentioned, I want to talk about the crypto thing a little bit more. So in the structuring that we're doing, everything we're doing at Gammon is about structuring. We're less interested in picking winners and picking undervalued stocks. Like the equity long short's a very difficult proposition. I don't think returns are very special in there. A lot of what we do is more trading in the indices. But when you're able to get exposures like that, structuring is so important because if you're able to control that downside risk, then you have an infinite upside. And it's that asymmetry of the risk reward that really matters a lot here. Whether it's the equity exposure or whether it's the crypto exposure, everything is about installing certain structures where your risk is very limited and contained and your reward is many multiples of that. And that's just the great thing about the asset classes that we traffic in. It's the great thing about having 20 years of background in the space as we know how to go into new products and basically create these synthetic types of options. And it just gives a lot of very favorable risk reward. And that's where you really start to see numbers like what we put up, where it's perfectly reasonable to expect a double digit or low triple digit number. All of those are very much in the cards.
Hey, Marty, can I jump in with a couple of questions for Michael?
Yeah, of course. Thanks.
All right.
Maybe taking it kind of back up to a 30,000-foot view, I'm just wondering how you see your strategy fitting into a larger portfolio.
Mm-hmm.
Early last year, I was a big fan of the Chris Cole's paper on the Dragon portfolio, and he talked about having 20% exposure to long vol. So is that like where you see your fund and strategy fitting in, or how else are you seeing investors use this if they are?
Yeah, great question. So one quick note that I want to address there. Let me take the screen off. 1 second. So one quick note that I want to address there is when you hear somebody talk about something like 20% long vol, typically the first thing I hear when I hear that is that's probably a traditionally trained vol trader. And I've done the same. I mean, I've been doing this for 20 years. But one of the big differences between them and us is they'll hedge risk with the exact same type of risk. So for example, if they have directional risk, they'll take directional risk to zero. Or if they have volatility risk, they're probably trying to run a relatively flat book, maybe even short if he's saying he's only want to be 20% long. So that's a very different approach to volatility than we're taking. We're obviously familiar with that. We've been doing this for 20 years. But when you structure things like we do, we're able to manage risks a little bit better and a little bit tighter. So when you think about where we fit into a portfolio, certainly equity exposure, any equity exposure you have, we would argue that the nonlinear positions that we can build by using lots of different options in the space is going to be far more efficient than any equity exposure that you'd be able to go out and get anywhere else. Now, having said that, if you still want to keep your equity exposure because you like the names you're in or whatever you have there, you can also treat us as tail protection. The vast majority of the time, I mean, I can't think of a time we ever didn't have a ridiculously amount of long left tail. You can think about us as a left tail protection as well. And then also, since what we're doing is based in the equities, it's also a lot of options on commodities. And we also diversify across the globe. So it's not just equity exposure there. It also starts to come down to a non-correlated exposure. Because if you take a look at our return streams, let me show that real quick, just to touch on this. If you take a look at some of our return streams here, get that out of the way, you can see that if you just remember, if you remember back to February, March, April, May, February and March looked very different than April and May. So for example, someone that just runs a naked long vol portfolio, they would have excelled in February and March, but they probably would have gotten destroyed in April, May, June, July, as that volatility starts to come back in. And that's something that a lot of these classically trained vol traders are going to be subject to, because they're not hedging and managing their risks the same way we are. We're a lot more efficient in our approach there. So you can think about us as tail risk. You could think about us as equity exposure. You could think about us as an uncorrelated asset to help diversify your portfolio. Or now that we're moving into this new structuring of call options on the crypto space, you could also think of us as your exposure to getting along the crypto space, just in an infinitely more efficient way than you ever could by going out and buying the coins.
Thank you, sir, for that.
Yeah, no worries. Long answer, short question. Thank you.
Michael, let me go through here. I've got some questions that were asked, and you kind of hit them in the special situations discussion. But one of the things I wanted to ask was, so you've been in the hedge fund business and vol for a long time. I mean, almost 20 years now. And but your returns have changed dramatically. Or I mean, you've always been very good at what you do. So what role does AI, machine learning play in that, and how has it made you change your game? And I'm gonna give an example that's kind of off base, but you know, when these what was it, the IBM Big Blue beat everybody in chess, all of a sudden chess masters adapted, you know, artificial intelligence programs to test themselves, to train themselves, and now there's more grandmasters, and they approach the game differently. Has this changed, you know, the fact that you guys are using AI and machine learning, has that changed your approach?
Yeah, so the great thing about AI and machine learning, there's a couple of things that are really important in here. One of the most important things is your chess analogy. So in chess, everybody's working towards the same objective, and that's to put the other guy in checkmate. So you're always optimizing towards the same goal. And what gets interesting about finance, and especially when you bring machine learning into the fold, is different people might have different investment objectives. So for example, you might care most about an absolute return. Just give me the biggest return you can possibly get. And another investor might care about a risk-adjusted return. And another investor might say, I want really high win rates on my strategy. So when you're using AI and machine learning, one of the really great things you can do is you can sit there and very specifically define what your investing objectives are. And that's something that I think everybody should be having discussions with their investors. I don't understand why these aren't normal conversations to have. Because when you have AI and machine learning, you have that ability to fine tune whatever you need to whatever you want in terms of getting exposures. So the AI and machine learning is super helpful from that perspective. And then the other perspective is you can sit there and you can go through these analytics, and it's taken us years to build this full analytics suite. But if you think about something like Amazon, the reason Amazon is so insanely efficient at everything they do is because everything is measured, everything is analyzed, and everything is optimized for efficiency. And having AI and machine learning at our firm is effectively the exact same thing. Everything is able to be measured, everything is able to be analyzed as such. So we can basically sit there and constantly say, this is what our models were predicting. This is how it actually panned out. This is within tolerance. This is not within tolerance. And when you have all of that type of analytical firepower, you're able to synthesize everything down and really find the best opportunities. And in the case of our quant portfolio, the most efficient opportunities to go out and build the structures that'll give you that best risk reward proposition.
Excellent. So, so 2020 was a great year. How do you see 2021, just on like the 30,000 feet, and
Yeah.
do you think that you see some? I mean, obviously, you guys did quite well in some of the months where COVID really spiked, and we're kind of taking this kind of I'm not even sure how to categorize it. Maybe Mark Heil knows because he's the son of a doctor, but there's kind of a lackadaisical approach because there's a real unproven approach that we're doing here with COVID, which is that the pharmaceutical companies say you need 2 shots over 6 weeks. And now we're going to the point where we're just going to give everybody 1 shot, regardless of whether there's a 6-week backup or not. And what I've been told by my medical friends is that you have to start the cycle all over again, possibly, if you don't get 2 shots in 6 weeks. So I mean, we might be looking at a spike again. So thoughts?
Yeah, that wouldn't surprise me at all. It's one of the things, I've got a couple high risk people in my family, so I've been doing some looking at this as well. And one of the things that makes me slightly uncomfortable is back when I was at Lehman and prior to Lehman, I used to trade a lot of the biotech derivatives. And again, that's a very tail heavy type of industry. But when you do that, you spend a lot of time looking at clinical trials and trying to understand the drugs and the indications and the market and all of that. And looking back at this, that's the sun again, sorry. Looking back at this, one of the things that is really concerning is it's impressive how quickly these drugs got to market. And, you know, I have to applaud them for that. But obviously you got to cut some corners when you're doing that. And historically, the FDA is not an institution that cuts corners at all. But if you take a look at some of these trials and the way they were constructed, I mean, I remember there was one test site that was giving half doses instead of the full dose of the drug. Now, that's something that immediately would be trial over, this isn't going to work, but that kind of got overlooked in this situation. Also, if you take a look at certain cohorts of people who got the drug, if memory serves, I think women who are on birth control or not on birth control shouldn't be taking the drug. I'm not sure exactly which one it is, maybe Mark knows. But suffice to say, there were little bits of the population where when they had adverse reactions, whether it was allergic or something else, they basically just got thrown out of the data set. They weren't analyzed properly. And that's mind-blowing. That is about as scary as financial institutions not having to follow accounting standards. So to the degree that there's any sort of friction around that or any unforeseen difficulties, or maybe even the rollout isn't very smooth, all of those also create possibilities for additional volatility in the year going forward.
Well, fantastic, Michael. Listen, obviously you had a great year in 2020. We're looking forward to similar or great results anyway. And 2021, it's hard to do what you did again, to duplicate it.
It's I got to be honest, you know, figuring out a way to structure some of those options, I am more excited about this year than I am about last.
Great, fantastic, good to hear. So again, Michael, thanks so much.
Well, thank you.